Speaking of forecasts, you get to put in one more before your retirement at the end of June. What's your outlook for inflation the rest of the year?
Yeah, well, you know, we're going to gather all the data that we're going to put together, and I'm going to put my forecasts in there. I still think, broadly speaking, that inflation is going to come down. That's my modal forecast, that we'll see inflation come down. I just don't think it's going to come down quickly. And so that's why it's really going to be this risk management kind of proposition, as the Fed always has to do, is sort of managing the risks around both of our dual mandate goals. If you remember back to the beginning when we started raising rates, monetary policy was not well positioned for the high inflation readings we were getting, and so we had to increase rates at a very quick pace and to a high level. You know, right now, I think monetary policy is well positioned for risk on either side. And so that's kind of, I think, what we're going to be doing going forward, is making sure that we're well calibrated for whatever risks end up happening. And so we're well calibrated now. If there is some deterioration on the real side of the economy that we aren't foreseeing, as you said, you know, we're well positioned to address that by lowering rates. If it turns out that inflation is stalling out, not my base case, or even going up, not my base case, we're well positioned to deal with that too, either by holding rates at current levels for longer, or if appropriate, raising the rate. That, again, that's not my base case. My base case is that inflation is going to start moving back down on a slow, gradual path back to 2%. But we'll have to see, and that's what we're going to be doing, is gathering information.
What odds would you put on the idea of inflation accelerating again, forcing you to maybe raise rates?
Well, I think there are upside risks. My base case is that inflation will gradually move back down, but I think we have to be open to the fact that, you know, the economy can surprise you. We've seen that during this episode of high inflation, partly, I think, because the pandemic was a significant event, and then the reaction to it was significant, and the economy may be changing. And so we have to be open to the possibility and be prepared for it. But again, my modal forecast is that we'll see inflation move down. But that's why we're going to be having to be very, you know, careful in monitoring what's actually happening in the economy.
When you do start cutting rates, how far do you think the Fed will go? What would be maybe the kind of neutral rate that Americans should expect?
Right. So I do think that there are reasons to believe that the neutral rate is higher than it used to be. And in fact, as you mentioned, we put in these forecasts 4 times a year, and the last one I actually raised my view of the long-run neutral rate. But, you know, we're going to be setting policy again to achieve our dual mandate goals. And so that's kind of what guides our everyday policy decisions over the coming months and over the next year or so. And that's where we're kind of getting to. The reason I thought that it was likely that the real rate would have to be higher than it was pre-pandemic is because there are reasons to think that investment will be higher. It's this balance between investments and savings that kind of drive where that neutral rate is. And there are reasons to think that investment's higher, that productivity growth may end up being higher than it's been pre-pandemic. We've seen a lot of automation going into firms that had to deal with labor shortages, and that automation will pay off in terms of higher productivity growth. So again, you know, not saying necessarily that we know where the neutral rate is, because we know that that can be estimated with a great uncertainty, but I do think there's reason to think that it may be higher now than it was in the past.
Only got about 30 seconds left, but one last question. This is going to be your last time to vote on policy and to put out a dot plot. Where's your dot going to be? How many moves?
Well, I haven't determined that yet. You know, I was on the record before saying I was at the median, which was 3. The developments I've seen in the economy right now, I would not think that that's still appropriate because the inflation risks have moved up given the progress on inflation. It stalled out in the first quarter. And frankly, the real side is a little bit stronger than I anticipated. So, but again, we're going to be guided by progress on those dual mandate goals. And we need to be more confident that inflation is on that sustainable downward path of 2% before we cut.